is Gail with TradersHelpDesk.com. Today I'm going to be presenting a crash course for new traders, especially those that are new to Forex. Now, for those of you that don't know me, I've been trading over 15 years now. I actually started out with a company that programmed indicators and simply fell in love with the price bar. I do specialize in price action, volume analysis, and divergence because I believe they are lead-in indicators. I've also been a frequent contributor to Stocks and Commodities magazine, Traders World, and Top Shelf magazine. I've also been a prior speaker at Traders Expo, Traders World Online Expo, and the Wyckoff Volume Conference. I'm also the author of Trading Nadex Binary Options, Keeping It Simple Strategies, The New Trader's Guide to Trading Nadex Binary Options and Spreads, as well as Trading Nadex Binary Options using currencies. Now, if you're new to Forex, let me just give you a highlight. Okay, it's the largest market in the world. There's no central exchange, which means there's no true volume, but we do use tick count as a supplement to volume. Now, you can trade Forex pretty much 24 hours a day. Technically, it's open 23 hours from 6 p.m. to 5 p.m. Sunday through Friday. Now, you do have different market openings around the clock. So you have Australia, Asia, Germany, London, and the U.S. Now, here's some differences between the currencies. Okay, the yen actually has, any currency with the yen has 3 decimal points. Okay, the third decimal point is considered the half pip. Okay, most movement is actually measured in full pips, so you really want to pay attention to the 2 decimal points on the yen-based currencies. All of the other currencies actually have 5 decimal points, with the 5th decimal point being considered the half pip. So you really want to pay attention to the 4 decimal points. The last one is not considered a full move because it is a half pip. Now, you also need to recognize the currency's strengths, weaknesses, and correlations. For example, the Aussie, 5% of their GDP is from mining, gold, diamonds, uranium, nickel. It is one of the largest producers of gold, so you have a positive correlation between the Aussie and gold. In other words, if gold is going up, more than likely the Aussie will also be going up. Now, another correlation is the Canadian dollar. Okay, it's the 7th largest producer of crude. Now, the USD CAD, if you notice, the CAD is the second symbol in that Forex pair. So there's a negative correlation. In other words, if the US dollar is going up, that means that the Canadian is weak. Okay? So just a couple of correlations that you do need to know. What are the differences between the currencies for intraday binaries? Well, number one, you do have 5-minute expirations on a lot of the currencies. For example, the Aussie dollar, the euro yen, euro dollar, the British pound yen, the British pound dollar, the US CAD, and the USD JPY all have 5-minute binary options. Now, all of the others do have 2-hour expirations. The only difference is when that 2-hour binary becomes available. So, for example, the Aussie yen actually has the first 2-hour expiration at 10 a.m. That means the 2-hour binary opens at 8 a.m. Okay, the Aussie dollar, the euro yen, the euro dollar, the British pound dollar, the USD JPY, they all begin at 6 p.m. on Sunday night. meaning that your first 2-hour binary expiration is at 8 p.m. Now, the other thing to note is your strike width. This makes a difference, especially if you're using out-of-the-money binaries. Okay, so on the 2-hour binaries, the Aussie yen has a strike width of 5 pips. The Aussie dollar is 4. The Euro British pound is a 10 pip strike width. The Euro yen, British pound dollar, British pound yen, and USD CAD are all 10 pips. Now, the remaining currencies all have a strike width of 4 pips. This really makes a difference when, let's say, you're expecting a 20 pip move on the USD JPY. That converts into a 5 strike move, which is pretty substantial. Now, all of the dailies have a 20 pip strike width. All of the weeklies have a 50 pip strike width. Now, when does Forex move? Now, most of the currencies will have some type of movement all the time. But, for example, Australia opens at 5 p.m. New York time. So that means you could focus on the Aussie dollar and the Aussie yen. Asia opens at 8 p.m. New York time. That means you could look at the Aussie yen, the Euro yen, the British pound yen, and the USD JPY. Germany opens at 2 a.m. New York time. And of course, you could trade any of the European currencies as well as the Swiss franc and the British pound. London opens at 3 a.m. and again, that opens up all of the European currencies, including the British pound, the Swiss franc, and the euro. Then you have the U.S. opening at 8 a.m., and that just means any currency is available to trade. Now, that is a cash market opening at 8 a.m. with the standard opening at 9:30 a.m. Now, one of the things I really love about the binaries with currencies is you can trade market reports. Because remember, you limit your risk on entry when you're trading a binary. You don't have to worry about stops. You pay your risk on entry. Okay? So on the Aussie, you have retail sales, trade balance, employment change, unemployment rate, and the cash rate, as well as the RBA rate statement. You can trade any of these using the binaries because, again, you limit your risk on entry. The pound has a ton of reports. You have the manufacturing PMI, construction PMI, services PMI, manufacturing production, the CPI, the average earnings index, prime minister speeches, the Bank of England speeches, retail sales, preliminary GDP, Bank of England inflation report, the MPC official bank rate votes, and the monetary policy summary, as well as the official bank rate and the second estimate GDP. On the CAD, you have the employment change, is really good to trade. You also have the trade balance, the unemployment rate, the Bank of Canada monetary policy report, and rate statement, which actually is coming out tomorrow at 10 a.m. Then you have the manufacturing sales, the CPI, the core retail sales, the GDP, the Bank of Canada governor speeches, as well as crude. On the euro, you have the ECB president speaking, the euro minimum bid rate, the press conference, the euro group meetings, and the German IFO business climate report. On the yen, any of the Bank of Japan governor speeches will be tradable. The Bank of Japan outlook report, policy rate, policy statement, and press conference. The only issue with trading those is they don't give you an exact time. So they're a little bit harder to trade. But you do have the preliminary GDP quarterly release, which is also tradable. Now, on the Swiss franc, about the only one that you really have is the SMB press conference, the chairman's speeches, the monetary policy assessment, and of course the rate announcement. On the US dollar side, there are a ton of market reports you can trade. The biggest one is non-farm employment change, which is the first Friday of every month. Then you have the core retail sales, of course, the FOMC rate announcement and press conference, the CB consumer confidence, the core durable goods, the CPI and core CPI, the ISM manufacturing PMI, the PPI, the preliminary University of Michigan sentiment, and of course unemployment claims. Now, unemployment claims has not moved the market as much recently as it used to. Now, that could always change. Okay, the next area that I want to go into is candlestick patterns. Now, this is going to be a brief overview. I do have some excellent videos on the Nadex website under videos that will teach you how to watch the candlestick patterns and read them. So this is just a brief overview. What I want to show you actually is how to learn the different candlestick formations, bullish, bearish, as well as multiple bar formation patterns. For example, this is a bullish candlestick, okay? And you can tell that because the body, which is this portion right in here, okay, is green, okay? In this one, the bottom is considered the open, the top is considered the close, and then you have the high as well as the low, okay? Now, this is pretty much, as far as the high and the low, with any candlestick formation, that will be the same. What will change will be the open and the close, okay? And in this case, because the candlestick itself, the body is green, then you already know that this is a bullish candlestick. Now, the red candlestick actually has the open at the top of the body, the close at the bottom of the body, and of course you have the high and the low. The red body identifies this as a bearish candlestick. What does it mean? Well, more likely than not, the next candlestick will be a bearish candlestick. Now, you have several different bullish formations, and these are multiple bar formations, okay? The first one here, if we draw a line off of the high and the low of the previous bar, you can see that the next bar, which is the green bullish candlestick, actually exceeds both the high and the low of the previous candlestick. This is indicative that the next candle will be an upward move. Then we have the next one, which is here, and you can see that that middle bar is lower than the first bar and the third bar, okay? And because the third bar is a bullish candlestick, that is indicative that the next candlestick will also be bullish. Then we have a 2-bar formation, and in this one you can see that we made a low, but then price pushed up and closed towards the high of the bar. This is indicative that the next candlestick will also be bullish. Now, we don't always get the perfect candlestick, which is why I put this one on here, because the concept is the same. They pushed down and they made a low, but then they took it all the way back up and they closed right near the top. Even though this is red, more likely than not, the next candlestick will actually be bullish. Then we also have this one where the close is equal to the open. You can see that because it doesn't have a body to the candle, okay? So this is the open and this is the close. They're equal to one another. But again, if you apply the same concept, price opened, they went down and they made a low, and then buyers stepped in and took it right back up. Okay, the next candle, more likely than not, will be a bullish formation. Now, the bearish formations are on this slide, and you can see the same concept as in the previous one. The only difference is it's telling you the market's probably going to go down. In this case, this is an outside bar because it exceeds both the high and the low of the previous bar, plus it closes below the low. This is a very strong formation that says the next bar will also more than likely go down. Then we have the single bar right here, and you can see this is the highest in this series. So if I was to draw a line off of the highs, this one is the highest. Now, what this bar is telling you is that the next bar will more than likely go down. And the reason is it went up and it made a high right here, but then sellers stepped in and they pushed it down, and they even closed below the low of the previous bar. That's indicative that the next price bar will also go down. Then we have a 2-bar formation right here, and in this one, price opened and it went up, but then they pushed it all the way back down to here. This was followed by a bearish candlestick. This combination is indicative that the next price bar will also be bearish. Then we have a candle that opens and it goes up and makes a high. Sellers step in and it goes down. Again, this is indicative that the next bar will be a bearish bar. Then we have a bearish bar that has made a high, closed right at the low of the bar. Again, indicative that the next price bar will go down. Now, these are what's considered bullish twin bar formations, and these normally develop at bear traps. In other words, they're trying to trap the bears in the market, and all of a sudden you see a push on the bull side. And in this one, you can see this is a bearish bar. It opened here and then closed at the bottom. Now, you would think that the next bar would be bearish, but instead they open and they take it straight up. Okay, this is normally will occur on lows when they're testing lows. That's where you would watch for this formation. Okay, and what it is they're trying to trap the bears in the market so that the bulls are actually controlling it. Okay, this one, the next bar should actually be a bullish bar. You also have a bearish twin bar formation, and in this case, this normally has tested a high, and this normally develops because it's a bull trap, which is just the opposite of a bear trap. Okay, they're trying to trap the bulls in the market, so they have pushed up and they're testing a high. Okay, and you have this bullish bar that forms, and the very next bar will be bearish, and it will be right at the high, and it is indicative that the market is going to go down. You also have what's considered a bearish doji. Always occurs at the top of a market. In this case, you can see this is the highest high, and you can also see that it closed on the very low. Again, indicative that the next market move will be down. Then you have the bullish doji, and as you can see, all of these are low. The doji will be the lowest in the series, but you can also see that it closed in the upper percentile of the bar. more likely than not, the next bar will be upwards. Do I trade price bars by themselves? No, I use a combination of price bars with divergence and with support and resistance. So in this part of the presentation, I'm going to show you what divergence is. Now, you have basic divergence, okay? And that simply means that you might be making higher highs in price, but you'll be making lower highs in the oscillator. Or you're making lower lows in price with higher lows in the oscillator. In this case, I'm using a stochastics, and you can see that here you have made lows, but on the stochastics, you are making higher lows. So here, this low is lower than this low in price, but as you can see in the stochastics is actually higher. This is indicative that the market is going to retrace, potentially even reverse. There is also hidden divergence. Now, hidden divergence is actually my favorite because it's a momentum move, but it's one of the hardest ones for traders to typically learn because it kind of makes you go cross-eyed. And what it is in this case, you're making higher lows. You have a low here, and then you have a higher low right here. But look at the stochastics. You see that the last low was here, but you're making a lower low with price making a higher low. This is indicative that the market is going to go up. Typically, it does it very quickly. Now, I like to combine these techniques with support and resistance. What is support and resistance? Well, any high will form an area of resistance that could potentially push price down. Okay? A low forms a support area, and that low will actually push price upwards. Okay? So in this case, you can see that they made a high here, they came back to test it here, and then a bearish candlestick formed, which pushed it down. Again, they made a high here, then they came back to test it here, and of course it goes down. Then they make a low, they come back to test the low here, but then you get a reversal bar right at the support line that's going to push it up. You can even see here in between, they made a low, then they came back to test it here, and then of course it moves up again. You can also see that pretty much all of these were candlestick reversal patterns. This is what you're looking for at areas of support and resistance. Then you add the oscillator, and that gives you your divergence. Now, let's put everything that we talked about together in one slide. Now, I use average true range as my support and resistance indicator. And average true range is just a measurement from high to low over X amount of bars. And anytime it comes back to that area and you either have divergence on the oscillator or the oscillator confirms what you see on the chart, then of course you can go into the market. Now, this is where knowing your strike width actually comes into play as well. When you see expiration here, that immediately tells me it moved less than 8 pips, okay? If you see profit here, it tells me it moved more than 8 pips. Now, this makes a difference, okay? Because let's say that you were doing an at-the-money binary, okay? And you can actually usually get an at-the-money binary for $45 of risk, okay? Or you could go one strike out, which is considered an out-of-the-money binary, and you can usually get the out-of-the-money binary for usually around 30 bucks. It depends on the time of day and how fast the market is moving as well, okay? So if every binary pays out $100, that means your profit potential on an at the money is $55, and your profit potential on an out of the money is $70. Okay? So you're risking 45 to make 55, or you're risking 30 to make 70. Okay? Now, of course, the out of the money are my favorites. Okay? Because you are risking lower to make a higher profit. Now, these, if you look at this one, and you can see that you're making higher lows, but you're making lower lows on the stochastics. You also have volume divergence, which I'll go through in another presentation. So that gives you an excellent opportunity to use this out of the money binary, okay? Because the volume divergence with the hidden divergence says more likely than not this market is going to move up, okay? It does move up. It expires in the money, so you made your $70. Then you go to the next one. The pattern repeats all the time, okay? So you come back to the ATR again. Again, you have volume divergence, and this time, this is a confirmation that the market is doing exactly what it should. In other words, you're making higher lows in price, and you're making higher lows in the stochastics. So again, more likely than not, this market is going to move up. Again, if you're using an out of the money binary, this is on the Aussie dollar. That means that you can go 4 pips from where price is currently trading. 4 pips is all you have to go, and you could potentially get that for $30 in order to make 70. Then when you come over here, you get another entry, and again you can see you're making higher lows in price, but you're making lower lows on the stochastics. Okay, again, go 1 strike out, okay, and you would be able to capture $70 in profit, provided you're able to get it for $30 in risk. And again, on the last one, again, I think this was early Monday morning on this one. Again, you get a lower low in the stochastics, a higher low in price. That's your hidden divergence, and up it goes. Now, if you notice over here, you went back and you tested this high right here. They formed a bearish bar. So this one actually shows that you had trend divergence, and you could have even went short off of that one, okay? So it's just putting everything together, knowing your strike widths, knowing what divergence is, choosing a support and resistance indicator that you want to use, that you understand, and then combine it with divergence, and you have a really awesome way to enter using out of the money binaries. And I mean, this one didn't even move 8 pips, and yet you could actually capture $70 in profit. This would be better than a 1-to-2 risk to reward ratio, which actually is ideal for any trader. Now, before I go, I do want to give you my email address. It's gm@tradershelpdesk.com, or you can visit my website at tradershelpdesk.com. Thank you, and I hope you have a wonderful day.